Mike Lowenkart with E-Trade Financial here with the market update through June. While a full-fledged trade war remains in the distance, the rhetoric from both China and the US seemed to weigh on investors' minds as the equity markets ended the month essentially flat. Small cap stocks once again outperformed large as these domestically focused companies are perceived by many as insulated from currency and geopolitical volatility. Despite global turmoil, here at home the Fed solidified its more hawkish stance, increasing projected rate increases from one more hike to 2 for the remainder of the year. That said, it remains to be seen if the market truly buys that the Fed will follow through on this more aggressive speed. Emerging markets pulled back in June, driven by weakness in China amid trade concerns and growth prospects, along with losses in Latin America as this region's equities are historically tied to the direction of the commodities markets. So the bottom line, as the July heat sets in, there are a number of important market signals to keep an eye on amid a volatile market beset with seemingly day in and day out global tensions. First, keep an ear to earnings. Q2 earnings season is about to kick off, and investors will be waiting with bated breath to see if the strength we saw in Q1 continues. Among particular focus will be earnings beats and forward guidance revisions. Any downward revisions could be a sign that the good times are slowing. Second, watch the yield curve. The yield curve flattened this month as the shorter duration front end of the curve rose after the Fed accelerated its projected pace. An inverted yield curve is a historically reliable indicator of a recession, which causes investors to watch its shape. While a flattening yield curve should raise some eyebrows, it's critical to remember that flat does not mean inverted. Third, consider the economic cycle. While identifying exactly where we are in the US economic cycle is a bit like pin the tail on the donkey, it is clear we have been in a prolonged period of economic expansion, and what goes up inevitably will go down. That's the cycle at work, and it's a natural part of investing. While some may choose to rotate into high-quality assets like large caps that can weather economic contractions, at the end of the day, being effectively diversified with an appropriate risk tolerance can be an investor's best tool to deploy. Thanks for watching, and we'll see you next month.